All right, guys, so we're here on our weekly Friday night wealth creation course. We're watching this live. We're streaming live on Facebook, Instagram, Zoom. We'll have this up on YouTube, all of the platforms. And I do these courses every single week. Okay, I've done them for basically 3 years in a row now. And the reason why I do this course every week is because I want to share my financial knowledge with people. Okay, I got interviewed this week for an article on Yahoo Finance, Fox, a couple other networks. And one of the things that was brought up was that I have insider knowledge. Okay, and it's true, I do have insider knowledge. I was a financial advisor for a number of years. And it's something where I gained information that most people don't get access to. And it's something that I want to share. Growing up, I was always interested in money. It was never something that my family was good at. It was never something we were strong at. It's not something that, I had a good experience with per se growing up. And so basically, as I started learning about money, I started to see the truth behind it. Okay, I started to see the truth behind it because I had been selling stocks and bonds and mutual funds and insurance and 401ks and IRAs. That was what I did for a living. And so there's kind of this threshold we've talked about, there are people that do nothing. They don't save, they're financially illiterate. They don't even know what mutual funds are. Okay, that's a layer of people. I've been there before. I remember when I first learned about a mutual fund, I thought it was the greatest thing on earth, right? Because it just blew my mind. I was like, I can own stocks. Me, Jerry Fetta, 18 years old from Big Lake, Alaska, I can own stocks. And then as I started to graduate into higher levels of understanding, I realized that there's another group of people that are into even more advanced stuff. And then there's another group of people that are into even more advanced stuff. And as you climb your way up to the very top, you get to see what are the wealthiest people in the world doing. And it's not something they talk about. It's not something they share. An example of this would be Warren Buffett. Everybody knows Warren Buffett. Warren Buffett is notorious for telling everyone to do one thing and then doing the exact opposite. Okay, telling everyone to invest in the S&P 500 index fund and then not doing that at all. Telling everyone gold is just a worthless, piece of dirt or piece of rock you bury in the ground and wait for, and then buying gold. Okay, so when you look at the wealthy, they're not sharing with us what they're doing. It's against what they believe. It's against their strategy to let us know. I posted yesterday, and it's very true. Finances are one of the only areas in life where there truly are haves and have-nots. I grew up as a have-not. Okay, I grew up, poor. My parents, my whole family, my mom, dad, me and my two brothers, we grew up like on $30,000 or less a year in income. Food stamps, free lunches in high school. I was a have-not, and I knew that I was a have-not, and I didn't know any haves. I didn't know people that had wealth. And as I started learning more and more and more about money, I realized that there are haves and have-nots because first, there are haves and have-nots when it comes to information. There are a group of people that have information, and there's another group of people that don't. And the group of people that have the information, unfortunately, use that advantage to take advantage of those that don't have the information. It's how our financial system works. It's the circle of life for the economy. And the sad part is the average American doesn't care. We don't want to know about finances. We're not interested in finances. When you tune in on my course and see me talking about money, you get turned off and go to do something else because you don't want to know about money. I've been there where I was so bad at money, I just didn't even want to know about it. So I would ignore it and pretend it didn't matter. And I pretended that live in the here and the now was the only thing until my mom died. And when I watched that happen, I was like, oh crap. If I would have had money, I could have done more. I could have helped. I could have contributed, had more responsibility. So it's easy to pretend that money doesn't matter. And it's easy about, all of this stuff until something happens. Okay. And we have that rude awakening where it's like, okay, now I have to know about money. And I don't want you to wait till you're the effect. That's why I do these courses. I can be cause or I can be effect. If I'm doing something because I was the effect, meaning something is happening to me financially and now I'm reacting to it, that's called effect. So if you're watching this, my intention for you is that you're not effect, you're cause with your finances, meaning you do shit, you make stuff happen. You're the one in the driver's seat. You are proactive before bad things happen to you. And so that's the intention of this course. Now, before we jump into this tonight, I want to do a couple of house rules here. First things first, if you guys have any questions, put them in the comments. Okay, drop your questions in the comments. I always want to answer those. I typically will answer those towards the end, but I'm still going to answer them. Secondarily, we're on the topic of finances. Finances are just math, but a lot of people feel like it's confusing. And the reason why people feel that like finances are confusing is because of the vocabulary. Math is symbols that represent problems and solutions. The brain reacts very well to math. We see that and we're like, okay, that makes sense. Okay, words are symbols that represent ideas, and they all have different pronunciations and translations, and they are all made up out of nowhere. So math, which we all get, becomes confusing when we enter vocabulary, language, right? The language of money and economics and investing in finances and taxes and all this stuff. That's where people get tripped up because they're like, I don't know what this stuff means. Okay, so if I say anything you don't know the meaning of, you get stopped up on it, your eyes glaze over, you start yawning, you start feeling tired, you start feeling like you're going to drop a critical comment to make fun of me because you don't know what I'm saying. That's a signal that you don't know what's being said. And I want you to actually ask, like identify, where was this making sense? Where did it stop making sense? And where did I get lost? And then drop that in the comments. That's the highest level of responsibility. And I want to hit this because it ties in with tonight's lesson. Okay. Like finances are one of the only areas that you and I have to take responsibility for. Nobody is going to help us understand finances. Schools don't do it. Okay. Your bank doesn't do it. Your financial advisor doesn't do it. Your mortgage guy doesn't do it. Your realtor doesn't do it. So I can have one of two results in my life. I can sit back and be ignorant and get taken advantage of by banks and taxes and everyone under the sun that understands money better than I do. And I can wait for someone to come teach me, which they're not going to. Or I can say, man, I can keep getting punched in the face and smacked around, or I can go start learning. Learning is a very active thing. It means I'm upset and bothered enough by my financial condition to do something about it. And the way that I do something about it is I know, I get knowledge, I learn, right? So that's really like why I want you guys asking these questions is it's the highest representation of responsibility when it comes to finances. Okay. And then lastly, no critical remarks, no negativity in our comments. This is a Friday night. I say this every week. There's two groups of people that are going to watch this. There are those who care enough about their future to actually stay inside on a Friday night and learn about money when they could be out with friends, they could be out partying, they could be going out with their girl or their boyfriend, whatever it might be, but they're choosing to stay inside and learn about money because it matters. I commend you. If you're that person, that's why I do these courses. Now, there's also the person that just doesn't have anything better to do on a Friday. They're either going to play Fortnite or watch porn or just troll people. Those people are here too. And so if you're that person, my hope is you become the first group. But if you're critical and negative, just leave. We don't want that here. Okay. So those are my house rules for the night. I want to dive into this. We are talking about life insurance, the sacred account. Now, I've talked about the sacred account for years and years and years and years and years and years. And basically, I have questions come up on a regular basis on like, well, what is it even? Like, what is the sacred account? Okay. And I'm going to dive into that tonight. It's going to get a little bit nitty gritty. So again, take notes, ask questions, but this is going to be a very high level economic lesson on what the sacred account is, why we use life insurance to save money, how it works, and really giving you the gears behind it all. Okay. Now, there's two things we're going to talk about tonight. The first thing we're going to talk about is the concept of life insurance. Okay. Now, if life insurance gets you all charged up and bothered, it's probably because you had a bad experience with it. You don't understand what it meant and you got ripped off. That happens 99% of the time. So more power to you. I'm going to acknowledge that happens a lot and it shouldn't happen. And this is how you prevent it from happening, is knowing what the hell it is, right? If you've never even heard of it before and you're like, I don't really understand the purpose of it or the idea behind it or why it's used, we're going to handle that too. Now, we're also going to handle the second topic, which is saving money. Okay, saving money, I get money, income, I keep it, and I have to put it somewhere while I keep it. That's the act of saving. And there's this phrase that I grew up with was, it's not about what you make, it's about what you keep. I add to that and I say, it's not just about what you keep, it's also about where you keep it. So we're going to talk about life insurance as its own subject. And then we're going to talk about saving money as its own subject as well. And I want to marry those two together today so that you really understand why we save money in life insurance instead of the other places people save. Okay. So first things first, we're going to talk about life insurance. I'm going to do some whiteboarding tonight. on Facebook and Instagram. I'll flip you guys around so you can see this as well. But let's go ahead and dive into this. Okay, so on the topic of life insurance, that did not make the shape I wanted it to make. Okay, on the topic of life insurance, there are two distinct categories that this falls into. Now, before we even jump into those categories, what is life insurance? Okay, life, we all know what a life is. I have a life, I'm living. I have, friends and family and people that I produce for, that depend on me, that I'm responsible for. I've got goals, I've got dreams, I've got ambitions. That's life. Okay, insurance refers to spreading my risk by using someone else's money. Renting money because I don't own it yet. We have car insurance. Why do we have car insurance? Because there's a risk that if I wreck my car, I might not have money to buy a new one. I might not have money to pay medical bills if someone gets injured. And so the insurance company is going to let me use their money. And I'm going to pay them rent every single month to use their money. Okay. Now, fortunately, I'm a good driver. I don't use my car insurance. That's kind of a hot button for me. I hate that I have to pay car insurance. Okay. There's health insurance, right? I'm insuring the risk that if I go to the hospital and they say, Jerry, you got the cancer, you got the diabetes, you need to pay all these bills now. What if I can't afford it? I'm using insurance. Okay, I'm using insurance. Insurance is me using the insurance company's money to pay my medical bills. I'm going to rent from them by paying a premium every single month to have that. No different, life insurance. If I have a life and I have goals and dreams, ambitions, people I love, care about, and am responsible for that depend on me, what happens if my life goes away, right? And what if I have debt? What if I didn't get to achieve my passive income goal for my wife or my kids, right? I'm going to insure against that risk. Okay, that's insurance. There's a value on that life. If that life goes away, that's going to pay out with someone else's money, a death benefit. That's basically insurance. I'm going to rent someone else's money so that if I die, those that I'm responsible for, those that depend on me, they're going to be financially set whether I'm still around or not. And so I insure against that risk. Now, in this category, there's two types of insurance, okay? There's two types of insurance. We have temporary and we have permanent. Okay, we have temporary insurance, we have permanent insurance. Temporary insurance is like car insurance. Okay, I buy insurance for 5 years or 10 years or 20 years or 30 years. And if during this period I die, the insurance company is going to pay my beneficiaries, my family, a death benefit. They're going to say, hey, Jerry was renting 250 grand from us because he didn't have it. So he died within the term, temporary. Again, it's just like a mortgage, the term. He died within our term, whatever that number of years might be. And so because of that, we're going to pay a death benefit out to you tax-free. That's how temporary insurance works. Most people buy 20-year term, 30-year term. If you worked with a snake oil salesman, you might have bought something called annually renewable term. And that is something I am sorry for if you got hooked into that. But these are the different types of term insurance that are out there. Again, temporary. They only cover you for whatever you signed up for. If that's 5, 10, 15, 20, 30 years. Okay. Now, here's the thing. The insurance company, the moment they go into an insurance contract, they owe you. Insurance is a contractual obligation. So the insurance company, let's say that I am insured for $250,000. They owe me that $250,000 if I die during that period. Okay, so they're actually taking on a liability. There's two parties here. There's me. I have lack of money, so I'm getting insured. Then there's the insurance company saying, I'm going to insure you. I'm going to give you coverage. So if you die in this period, we pay you out. Well, now they're on the hook. Okay, temporary insurance, because of the human mortality rate, meaning the length of our life on average now, there's only a 2% chance that the insurance company has to pay you a death benefit because you'll live past the amount of time you signed up for. 2% chance. Okay, out of 100 people, they know that they're going to have to pay out on 2 of them because 98 of them live past what they signed up for, and then they're no longer covered. It expires. The obligation is gone. That's called temporary insurance. Okay, now permanent insurance over here covers you till age 121. There's no term on this. It's covering you for your whole life. Okay. That's why it's called whole life insurance oftentimes. It's covering you till age 121. Okay. So if I sign up for $250,000 of coverage on a permanent policy, the insurance company knows I have to pay this. There's no way out of it. It's not a 2% chance that Jerry's going to need the insurance. There's a 100% chance because it's permanent. I will pay out no matter what. If I live till 121 or past that, then the death benefit, they would pay it actually while I'm still alive. So no matter what, they have to pay. It's a 100% chance. Whether I live or die, I'm going to get my 250 grand. The insurance company knows that. They're instantly on the hook with a liability. Liability means they owe something. There's assets, things that I own, liabilities, things that I owe. The insurance company officially has a liability on their books. Okay. Now, we don't do term. Term is temporary. Okay. So we're not looking for you to have renting your death benefit and hopefully you might not need it. And then the insurance company makes away with 20 or 30 grand off you over the next 3 decades and gives you nothing. We don't want that. So we're looking at permanent here. So in the characteristics of permanent insurance, we have, again, whole life. What's happening here is I am paying what's called a premium. Okay, just like we all pay premiums. Health insurance, we pay premiums. Auto insurance, we pay premiums. My premium dollars go to the insurance company. Okay, so we have the insurance company over here. They're getting my money. Insurance company. Okay, now, like we said down here, they know already that they have to pay me 250 grand at some point in my life. They know that I'm probably not going to die till I'm in my 70s or 80s. So they know they've got some time, but they know for a fact they will have to pay me that 250 no matter what. It's owed to me. Okay. Now these premiums I'm paying them, let's say that I'm paying them $400 a month. Okay. They know that between now and when I die, they can turn that $400 a month into 250 grand. Okay, that's guaranteed for them. They will guarantee that because they know their numbers, they know their investments. They've been around for 170 something years. They just know if you give me $400 a month, I can give you a guarantee of 250 grand at some point in your life, no matter what. Okay, this is the basic agreement here. Okay, but you have to realize I'm giving them money every month. And then they owe me a death benefit. They have to pay that out. There's a 100% chance that I'm going to get this with permanent insurance. So if you think like an insurance company, if I owe somebody, what's the first thing, if I'm a person, that I'm going to try and do? I'm going to try and pay them off. If I owe them, I'm going to try and pay them off. Okay. So this is called my death benefit. There's another thing here called a cash surrender value. Okay. And what this means is the insurance company, they're going to give me the option to take money and walk away because they know that I have to get paid this 250. So it's in their best interest for me to not do that. If they don't have to pay the 250, they don't want to. So they're going to say, hey, there's this thing called a cash surrender value. And we're going to show you this $400 a month you've been putting in at the rate that it's growing, how much it's worth if you just take money and walk away now, and we don't have to pay you the 250 grand. That's literally what's happening here. They're saying this is building up. Here's this account that we have with your money that you're paying us every single month, this $400 a month, and we're growing it and we're growing it and we're growing it. And if you so choose, you can take the cash, surrender your policy, give it back to us, and we will give you the value of the cash in there plus the growth. This is the basic mechanics of life insurance, guys. So when you have a death benefit, it's a contractual obligation. The insurance company has to pay this. They're looking at that number and they know that it's a liability on their books. If they don't have to pay it, they don't want to. Now they have to unless you agree that you don't want it. So they're saying at any point you could take your cash surrender value and we would give you the money and you can just get rid of the policy and we don't have to pay you anything. So for them, this is a liability on their books. Okay. For you, this number is an asset on your books, meaning you could take that number any day now and it's yours. It's guaranteed. If you were to take that cash surrender value, it will be there. You can count it as a liability, or sorry, as an asset. You can count this number as an asset. Now, this is the basic function of it. Now, the next thing here is, and let me clear some space off here. this number that you have in cash surrender value, because it's an asset, like any real asset, you can borrow against it. Okay, who here has a house? Okay, anyone that's got a house, you can take out something called a home equity line of credit on your house. You can do the same thing with your life insurance. You can take a line of credit against your life insurance, and you can use the money and keep the policy, and this will still grow. Nothing fancy there. That's all that's happening. Okay, they owe me this. They're offering that I can be bought out with this. This is now an asset for me. I can take a loan against that asset now, and I can use the money even though I still have this growing because it's a line of credit. When I take a line of credit against my house, the house does not disappear. It still appreciates. It's still there. If it's a rental, it still gets income. Same exact concept. Okay. Now on this line of credit, I don't ever have to pay it back because if I die, they'll just subtract what I took out of my death benefit. They're just going to say, hey, you took out 100 grand. We gave you part of that death benefit early, essentially. So we're not going to pay you 250. We're going to pay you 150 because you advanced the 100 to yourself on a line of credit. Okay, this is the basic mechanics. I want this to be simple for everybody. They owe me money. They don't want to have to pay the money, so they're going to give me a cash surrender value that I can take any time. Even though I don't have to take it, I can borrow against it. If I borrow against it, I'm basically advancing the number that they owe me back to myself early. And if I don't pay it back, then they're just going to take it out of the death benefit because they don't owe me that money anymore since I borrowed against my values. Right? Now, the line of credit, I'm going to pay them interest. I'm going to pay them interest on this line of credit because it's a loan. That's how loans work. When I take a line of credit against my house, I pay interest on that line of credit. So the question becomes, A, what am I paying? B, what am I earning? And then C, what could I go earn with this money over here? And that's what the sacred account's all about. Okay, so basically what we're going to go through today is I want to show you guys real policies, real life insurance policies. Okay, I'm going to go over 3 examples. I'm going to show you what's called a sacred account light. I'm going to show you what's called a sacred account premium, and I'm going to show you the sacred account for accredited investors only. Okay, so I'm going to unshare my screen here, and we're going to dive into these policies here. And again, guys, if you guys are at any point getting lost in this, ask questions. Let me know in the comments. If you guys have questions, I want to make sure we hit those. But we're going to dive into some numbers here. This is going to be very spreadsheety. Okay, so I'm going to zoom this in nice and big for everybody. Okay, so this is called the sacred account light. Okay, so we just talked about life insurance. I'm going to show you how this works. Okay, so I have a sacred account. This is a life insurance policy. It's a permanent life insurance policy. This is a real illustration. This is for someone that's 24 years old. Okay. And what's happening is they are going to sign up for $185,000 worth of life insurance. That is their death benefit. That's how much they're getting from the insurance company. Let me zoom this in even more. Okay, that's what they're getting from the insurance company if they die. Now, you'll see that that death benefit actually goes up every year. Okay, the reason being is they have the policy structured to where the death benefit actually grows. So at the end of this person's life, let's say they die at 73 years old, they've owned the policy for 50 years, the insurance company has to pay them $244,000. Okay, they have to pay them that. So the insurance company is saying, okay, well, we have a liability of $244,000. We have to pay this to our insured because he signed up for it, and he's been paying us, you know, $3,600 a year for the last, 10 years, right? So he's paid 36 grand to us over this period. So what they're going to say is they're saying any given year, if you want to take money from us and walk away, not take the death benefit, here's what we'll give you. In the first year, we would give you $2,600 if you just cut the contract with us and take the money and walk away. In the second year, because you've had the policy a little longer, we would give you $6,000. Okay, in the third year, we would give you $9,000. So every year, that cash surrender value increases. Okay, if I were to take the money and walk away at age 73, they would be giving me 155 grand to basically drop my policy. Okay, they'd give me 150 grand, 155 grand, but they wouldn't have to pay me the 245. Okay, that's if I surrender my policy. Now, surrender means I'm quitting. I'm canceling the contract. It's not borrowing against it. We're going to talk about borrowing later. Surrendering literally means I'm going to cancel the contract. I'm going to cancel the contract and take $155,000 and walk away and never do anything with the insurance company again. They got off the hook because they knew they were going to have to pay me $244. But if I wanted the cash, I could take the surrender value and leave. So that's a real policy. Now, the difference is, like I said, this cash value, this surrender value is also an asset to me because I could take that money contractually. I am able to anytime I want to. So this first year I put in $3,600 of my own money. My surrender value on my policy is $2,681. I could quit my policy and get $2,600 back. Now it's less than I put in, so I wouldn't do that. But I can also go get a collateral line of credit against this $2,600, meaning I can borrow against it. I can go to the insurance company and say, hey, I have $2,600 in my account with you guys. Okay, I want to take a loan against my money. You give me $2,600 of your money. My money will stay in my account and keep growing. And I'm going to go use that $2,600 and do whatever the hell I want with it. And if I don't pay you back, that's fine because you owe me $184,000 anyways. You can just not pay me the $2,600 I owe you. They're cool with that. So you'll pay them interest to borrow this money, and you'll use this money to pay off debt or to invest or whatever it might be. Okay. Now the beauty here is that this $2,600 is going to grow. Okay. So I'm putting in 3,600, 3,600, 3,600, 3,600. So by the 10th year of this, I've actually got more in my cash value than I actually even put in the policy. Notice I'm not funding it after year 10. I funded it all the way through the first 9 years. After year 10, this Sacred Account Lite is only a 10-year contribution period. I'm no longer putting money into it, but my cash value keeps going up. Okay, it keeps going up, and I can borrow against this number anytime I want to. So the Sacred Account Lite, 10-year funding, $300 a month, $3,600 a year. This is specifically designed for someone that's paying off debt. Someone that's paying off debt. They would be looking at, I've got $300 a month right now. I'm going to put that in my policy. I'm going to borrow, like we say, 70 to 90% of that. And that's 70, 90%. Let's find out how much that is. If we divide our values here, if we go, okay, so we've got cash value here of 2681. Okay. And if we divide that in the first year by what we put into it, that's 75%. So I can access 75% of my money on a loan, and I can use that now to pay off my debt. Now this 3,600 is still growing. While I'm using this money that I put in, this money over here is still growing at a 3 to 5% tax-free annual interest rate on average. And so you can see that because of the fact that after I put in all this money, it's still growing and it's got more cash value than I've actually contributed. So the idea behind this is again, the insurance company, they owe me this. They owe me the death benefit. At any time, I can take a cash surrender value. I don't have to, but I can. And because I can, it's considered an asset. Because it's considered an asset, I can borrow against it. Just like my house, just like my car, just like my gold and silver, I can borrow against it. By borrowing against it, I'm going to use the value of the money that's here, but my money still grows because my money never left my account. I'm borrowing from the insurance company. Okay, this $2,600 is their money, not my money. My money is over here. It's the $3,600. It's still growing. So if I set this up correctly, this $3,600 grows at 3 to 5% interest. That's a positive gain. And if I set this up correctly, I'm only going to pay them 2 to 3% interest on the $2,600, meaning I'm making more than it cost me to borrow. So if I'm paying off debt with this, I'm going to pay off debt and I'm going to get paid to pay off my debt. Okay, I have this $3,600 paying 3 to 5%. I'm borrowing this $2,600 out at 2 to 3%, meaning I'm making 1 to 2% to go borrow my own money. If I use that to then go pay off my own credit cards or my car loan or whatever it might be, I'm now also making money by not paying interest on that thing that I just paid off. Right? So I'm going to do this until my debt's all paid off. And basically the alternative here that I want to show you guys, this is a real comparison against a bank account. Because like I said, we're going to talk about life insurance. We're also going to talk about saving. Okay. Most people don't save in life insurance. That's usually reserved for banks and corporations. Most people save in banks. Okay. They give their money to the bank and that's it. Okay. So what I did is I showed the same exact outlay, right? $300 a month going into a bank account for 10 years. Okay, now if I put in $3,600 into my bank account, what's happening is I'm actually loaning $3,600 to my bank. I'm not depositing into an account that I own and it's my money. No. I gave it up. As soon as my money went in the bank, it's no longer mine. It is legally and contractually the bank's money. I loaned them $3,600. Now, the average bank pays me 0.10% to use my money. So that means that I made 36 cents in the first year. Now, you might look at this and you're like, yeah, but in the life insurance, I've only got $2,600. Over here, I've got $3,600. Yeah, well, check this out. We get down here to year 10, you've got $36,019 that you can pull out of your bank, right? Now, if you pull that out of your bank, you don't keep earning interest on it. As soon as you take money out of your bank, you're done, right? So if I take $3,600 out, I'm not going to have 7201 the next year because I took money out. With the life insurance, if I take $2,600 out, I am still going to have $6,005 in my cash value next year, even if I took the money out, because all of my money still grows. Now, after the 10th year, which is pretty much a break even here, the life insurance kicks the bank's ass every single year after, right? So the first year you can see this, right? We'll zoom it in some more. Life insurance, 37 grand, bank, 36 grand. The next year, life insurance, 38 grand. Okay, bank, 36 grand. Life insurance, 40 grand. Bank, 36 grand. How long does it take you to even make more than 36 grand in the bank? Let's check that out. If you go all the way down, all the way down, all the way down, you never make more than the 36 grand you put in. You made 164 bucks after 50 years. Why in the hell would you save money in a bank? Okay, not only that, if you die, they're only giving you what you had in there, plus the interest. And you're going to pay taxes on the interest because the IRS will tax you on that 164 measly dollars that you earned in the bank. Okay, on the life insurance, I've now got 155 grand. Same exact money, but it's 155 grand. I can use it all along. It grows if I take it out. If I die, my family actually gets 245, not 155, and none of it's taxable. Guys, this is why we call this the sacred account. This is a no-brainer. Why would I loan money to a bank? By the way, the reason people loan money to a bank is because of the FDIC insurance. When you put money in a bank, it's supposedly covered with deposit insurance. Did you know the deposit insurance only has enough money to cover 1% of deposits in the country right now? Meaning if the bank went out of business, you would be responsible. It's called a bail-in. Your deposit, your $3,600 or your 10 grand or whatever you've got in the bank would be responsible for making the bank solvent. So yeah, you might get $250,000. If you're above that though, you're screwed. If you have $1 million in your bank, you're going to get 250. They're going to keep the 750. Because after 2008, the government said no more. We're not going to bail out banks any longer. So it's called a bail-in. Those with higher account values will lose their money. Those with lower account values are going to get the FDIC insurance if it even pays out, because there's only 1% reserve ratio against the deposits in the country. Okay, so this is the Sacred Account Lite. Okay, this is the Sacred Account Lite. The next thing that I'm going to show you guys here is called the Sacred Account Premium. Okay, the Sacred Account Premium, this one is a little more complex. So on this one, what I did here is I showed basically this versus a 401k. Similar concept. Okay, this is actually my age. So I did this on me. This is not my policy, but it's my age. So if I'm maxing out my life insurance policy with the same money that I'd max out my 401k with, which is $19,500 a year, right? So let's say I'm putting $19,500 a year into my life insurance. I now have a contractual obligation with the insurance company that they have to pay me $2.2 million. They have to. There's no way around that. Down in my old years, when I get to, end of life or senior years, they're still going to have to pay me. It's going to be now about 2.1 million. No matter what, they're going to have to pay me about $2 million. Okay. Now, what I'm seeing here and what I'm showing you guys here is they're telling me, Jerry, if you cash your policy out, we will pay you 15 grand to walk away. We don't want to pay you 2.2 million. We can, but if we don't have to, we don't really want to, because that's a lot of money to guarantee to have to pay to someone. So you can have your 15 grand if you just walk away. or you can keep the policy. We're cool with it either way. I'm going to keep the policy. Now, what I'm showing here is as I'm putting money into my sacred account, as soon as my cash value gets to above 50,000, I'm going to take out a loan against the policy. Like I mentioned, it's an asset. I can borrow against it. I'm going to put that into an investment that cash flows. So in about year 2.5, I take my first loan and I do a real estate deal with it. This money that I've put in is still growing. It's still earning 3 to 5%, but I've now borrowed against it. And now I have $57,000 in real estate, cash flowing every single month for me, right? Now, the beauty of this is I'm still contributing to my policy. I've still put in 19.5. I'm still pumping money into that thing. This next year, I've got enough in there to do another real estate deal. So now I've got 91,000 in real estate, plus I've still got my cash growing for me. And you can see this all the way down, this arbitrage investment. This is me borrowing against my policy, putting the money in real estate, paying myself back, and then still contributing on the front end. And what ends up happening is I grow this side over here. At the very end of this, you can see it's just compounding. I grow my real estate to $6 million. Okay, $6 million in real estate. Plus, I've still got my cash value of 940 grand growing because that money never left. I can take this out and it's still going to grow the entire time like nothing happened. Okay, so here's what I made on this though. My annual growth rate, I'm making about 9.16%. Okay, after I pay taxes on my real estate, I'm down to about 8.16. My total fees to do this are about $2,922. My real estate, I'm going to pay taxes of about 1.8 million. After all of these costs, I've made about 8.16% a year. Okay, so these are my different returns. Now let's compare this to the glorious 401k plan. Okay, the 401k, the god of investments that's only been around since 1979. Okay, so $1,625 a month, same thing going into it, comes out to $19,500 a year. Now what I did is I based this off of the S&P 500 annual return minus fees for the same period of time, which is 30 years, right? So if I do this, I'm looking at doing this for the next, 33 years. So I'm doing it till I'm 60, okay? So what's happening here is I'm putting in 20,000, essentially, 19,500. My 401k balance is 20,508. But if I die, I'm going to pay taxes on that money. So if I try and pull it out, I'm actually only going to have $14,000 in there. Right? I had a client that just this year, he cashed out his SEP IRA. It's true, you pay taxes and penalties when you do that. So I might have 20,000 in my account, but I can only have 14 of it. Right? And there's no death benefit. If I die, I don't get any more than I have. So what happens is you'll see my value of my 401k grows with the stock market and with my contributions, but my death benefit, it's lower than what I've actually got in there because of the taxes that are going to be paid on this account. Now, I can't do arbitrage investing in my 401k. I can't borrow against my 401k, still have the money I borrowed growing, and go do other investments. I can take a 401k loan, but that money that I borrow out of my 401k doesn't keep growing. I've got to pay myself back on a 5-year term. It's typically 5% interest, and the cash flow just doesn't make sense. So I can't do arbitrage investing. Over the last 33 years, my 401k would have grown to 2.8 million. Okay, just in the 401. Now, somebody might look at this and be like, well, that's more than the 940,000 in the life insurance. Yeah, but the life insurance isn't the investment, the real estate is. The life insurance is the icing on top of the cake. I made $6 million in real estate, and because I used life insurance, I get a bonus of 940. If I do the 401k, I get 2.8 million in my 401k, and after taxes and stuff, I'm only going to have 1.9 million of it left. Now, here's the kicker. Over the last 33 years, the S&P 500 has averaged a 9.67% annual rate of return. Over the last 30 years, that's what the stock market's made annually. After I pay taxes, I only get about 6.77% of that. After I pay fees, which on this account, I would pay $1.3 million in fees. That's my cost of fees, meaning the potential value of my account costs me 1.3 million because of the fees that I have to pay on this 401k. My taxes are 844 grand if I withdraw the money, meaning my net rate of return is 4.32%. Inflation is 5. So I lost 70 basis points because of my 401k plan. But why does everybody do this? Why does everyone do the 401k? The bank doesn't. The bank does life insurance. I'm about to show you something crazy with life insurance. The bank is doing what's over here. Okay. So everyone in the middle class is over here being convinced to do the 401k plan when after inflation, they didn't actually make any money. They're at a net loss. Your account value looks cool, but if you pay your taxes and your fees and all that stuff, you're going to net barely more than inflation or less than inflation. Okay, and the reason I show this is because the average person that's out of debt, that cares about investing and saving and all this stuff that we talk about, they're doing the 401k. They're doing the 401k plan. And this is what it looks like, and they have no idea. Okay, so the other part here I'm going to show you guys just for fun, and this is mean of me to do this, but I'm going to show you just for fun, is the bank. What if we saved $19,500 in the bank? Because I have people watching right now that have $100,000 or $200,000 or $300,000 in their freaking bank, meaning they loaned a $19,500 unsecured deposit or unsecured loan, if you want to look at it the way that it really is. I loaned the bank 200 grand unsecured. They don't have to pay me back. There's nothing guaranteeing that. So if I put my 19,500 in the bank, I'm going to have $19,501.95 in the first year. I made $1.95 for loaning 20 grand to the bank for a year that I can't touch. Because if I touch it, I don't earn interest on it anymore. I have to leave it there, right? Second year, 39,000. Now you see this number is lower because I will pay taxes on my gains. Okay, and if you can call them that, gains, right? But at the end of this, let's go to the same time period. At the very end of this game, I have $390,000 in the bank. $390,000 in the bank. If I pay my taxes, I've only got $390,818 in the bank. My annual rate of return was 0.01%. My taxable equivalent yield, meaning after I paid my taxes, was 0.006%. I paid $1,983 approximately in bank account fees, and I'm going to pay about $245 in taxes. That's what I make. Okay, think about where the average person saves money. It's either the bank or it's the retirement plan. It's not life insurance. And I'm showing you tonight the illogic behind using the bank and the retirement plan. Did you know this bank that you're depositing your money into, on average and across the country now, banks have $180 billion of reserves in life insurance. $180 billion. That's 20% of their, they call their tier one capital, their highest level of reserves, the most prized money that they have, they've put in life insurance. They have done the exact thing over here on this side of the screen that I'm talking about. They're using their life insurance. This is why we call it the sacred account, guys. Now, the final thing that I'm going to show you, this is not something I've ever talked about publicly, and I'm going to tonight, is the sacred account for accredited investors. Okay, so we talked about the sacred account light. That's for someone that's just starting out and they're paying off debt. Okay, we talked about the sacred account premium. That's for somebody that has paid off their debt. They're going to now upgrade into the premium account because they have more money they can save, and that's, you know, a longer contribution period, and we're looking at investing. Now, when you're accredited, you can do what's called a corporate-owned or bank-owned style policy. It's an executive-based policy. It's what banks and large corporations use. Now, the minimum contribution to do this is $100,000 a year. You have to put $100,000 a year into this to be able to even qualify. So that's why we say you're accredited, because you're only allowed to save about 25% of your income into life insurance. So if you do the backwards math on that, if you're putting 100 grand into that policy, that means that you're making about $400,000 a year in adjusted gross income or taxable income, meaning you're accredited. So you have to be accredited to do this policy. Now check this out. This is an illustration again on my age, right? I've put $114,000 in the policy. That's my contribution, right? That bought me $13 million of death benefit. I'm going to zoom this in a little bit more. So again, the insurance company owes me $13 million. They have a booked liability. They have to pay me that money at some point in my life, no matter what. So they're saying, Jerry, if you take 106 and walk away, you can just have the 106. Or you can borrow against the 106. Now, we've talked about liquidity. We said on the sacred account, you typically are going to get 70 to 90%. On this one, it's better. This is why banks use this. If I take my cash value, which is 106, 340, and I divide it by what I've put into the policy in the first year, which is 114,989, that's about 92.5% liquidity, meaning if I put in $1, I can borrow about 92.5 cents off that dollar. This is unheard of. If we jack with this thing, we can get it up higher. We can get up to 95, 97% sometimes. I just did a really basic illustration to show you what's out there. So if I put this 114 in, I can borrow the 106. The 114 that I put in is still growing at 3 to 5%. On 106, I can get you a corporate life insurance line of credit through our brokerage, which you're going to pay 1 to 2% interest on. Not 2 to 3, 1 to 2%. So I'm making 3 to 5 and it costs me 1 to 2%, meaning I'm going to be making a 3 to 4% profits. Can go do a deal. Okay, check this out. This stacks up so fast because of how much I've got going into this thing. I put in my cumulative contributions is what I've put in total. Okay, so my break even happens here in year 6, right? I've put in a total of 114, I've got 106. I've put in 229, I've got 215. I've put in 344, I've got 329. I've put in 459, I've got 450. I've put in 574, I've got 578. My break even happens twice as fast as on the light account, the premium account. And again, we could make this happen in 3 years if we wanted to. But I have to be accredited to do this. Guys, this is literally the policy banks use. This is exactly how they design it. You can see the giant death benefit that they use. Now, the difference is that most companies at this level have employees. So this 13 million is not Jerry signing up for life insurance of 13 million on Jerry. It's Jerry signing up for $13 million of life insurance on Nano, because Jerry pays Nano, and when Nano dies, Jerry is going to get a refund of $13 million tax-free. Banks insure their executives. That's who they put the death benefit on. So they're going to use the cash value in the interim. They're going to invest with it, grow it, use that. And then when the executive dies, they're going to get a payout. And that's exactly how they do it. So you get these large corporations, accredited companies, trusts, etc. This is how they're doing their life insurance. Okay, now I know this is foreign for so many of us, but I want to tell you, like, let me flip Instagram back around because I think you guys have seen enough spreadsheets tonight. This is something that's been around for over 150 years. It's been around longer than your bank. It's been around longer than the Federal Reserve Bank. Like, this came before we had a central bank in the United States. This came before your bank existed. This came before any institution you currently put your money into. So why is it that something that's been around for 150 years minimum is unheard of? This is not advertised on TV. When you watch CNBC, you don't see this. You see Charles Schwab and Fidelity and Vanguard. Why is that? Okay, and why is it when you look at the top 1% of wealth and the actual banks you put your money into, they're putting it in this. They're not doing the 401k plan. Okay, I can walk into a bank right now with my life insurance policy and I can say, guys, I want to get a loan. And they're going to say, for what? And I'm going to say, I want to get a loan so I can buy life insurance. Banks will actually do that. It's called premium financing, meaning I would borrow $1 million from them and use that $1 million to go fund a life insurance policy. Instead of paying premiums, I'm only going to pay interest. And then I'll just borrow against my cash value and pay them back later. That's another thing accredited investors can do. But I can walk into a bank, borrow money from them, use it for life insurance, and they will do it 100% of the time. But if I walk into the same bank and I say, I want to borrow money, and they say, what for? And I say to buy stock, they're going to say no. If I say to put it in mutual funds, they're going to say no. If I say to put it in my 401k plan, they're going to say no. Why is that? Why is that? Like, think about that. That's an out point. That should be something that makes you think, why can I go buy this? Same with real estate. I can walk into a bank and buy real estate with a loan. They'll let me do it. They won't let me do that with stocks, bonds, mutual funds, any of that stuff, right? So the whole point of tonight is I want to give you guys like real solid data on how does life insurance actually work. It's very simple. I pay a premium. I'm renting a death benefit that they're contractually obligated to pay me, and then they don't want to, so they're going to give me a cash surrender value. If I take the money and walk away, that's what I'm going to get that year. I don't have to take the money and walk away. That's now an asset because I get it no matter what. And then I'm going to borrow against that asset and use that to pay off debt, to invest, to buy cash flowing properties, whatever it might be. And then I'm going to continue doing that until I have enough cash flow coming in where I could do an accredited policy and I could put $100,000 a year into it. And I could have an executive in my company insured. Okay. So guys, that's all I have for you tonight. I do want to open this up for questions. I'm going to hit Instagram first just because you guys have an expiration date on Instagram. They shut this down usually after an hour is the limit, I think. All right, so if you guys have any questions on Instagram, drop these in the comments. I know tonight was very spreadsheet and numbery and wordy. So if you guys have questions, let me know. Good to see everybody, by the way, on Instagram. Same with you guys on Facebook and Zoom. I don't see any questions yet on Instagram. Dave, my lender, dropping bombs brought me here. Love Bradley. Awesome. Had a great time on that show. I'm going to be on with Kevin Harrington later this month. So I'll make sure I let you guys know when that drops. So question, so you don't have 1 million or they take out of that 1 million. So this is a question about what are you borrowing? Are you borrowing against the death benefit or the cash value? I can only borrow against my cash value. So I can't go borrow against my death benefit. That's not money I can take. It's the cash surrender value. The death benefit is what they owe me in the future. The cash surrender value is what they'll pay me today to walk away from my policy. That's the number I can borrow against. So sometimes this is pitched inappropriately where people will make it sound like you can borrow off your death benefit. You can't. There's no game in the world where you can deposit $19,500 and then be able to access 2 million bucks. Okay, that's fairy tale land. If I put in 19,500, they'll give me a cash surrender value of about 70 to 90% of what I contributed, and I can borrow against that number, and that stacks up and builds every year. Very good question, though. We are talking about investing. How much do you earn from cash value versus premium? So you earn about a 3 to 5% total growth rate between your cash value and premium. About, like we looked at 10 to 30% of your dollar is going to go to your premium. The rest of it goes to your cash value. And then the total of that is about a 3 to 5% compounding annual growth rate. And you'd measure that just by looking at your illustration. Optimum split. So the optimum split is really case by case. So AJ is asking, like, when I put money into this policy, what's the optimum split of how much should go to cash value, how much should go to premium? If I'm paying off debt, then I should try and push my split up as high as I can. That's why we might do like a 10, like you saw the Sacred Account Light, a 10 fund, because I need really high cash value for a short period of time to handle my debt. If I'm in the premium account, then it's more about long-term wealth building. Which one has the higher growth rate? Okay, that might be a little bit of a different split. If I'm on an accredited policy, totally different ball game. That's going to be the best of both. I'm going to have the higher split and the higher growth rate because they literally design these for banks. They literally will design this for Bank of America and Chase and Wells Fargo and JP Morgan. Let's see what other questions we have here. Someone said you should tell me this when I'm an adult. Touche. Come back to me when you're an adult. We're happy to help you out no matter what. I could use this information in about 5 years. Come back to us in 5 years. If you guys are on Instagram and you're young, I was young. I'm 28 now, right? So I'm not that old. I was young when I got started with this stuff. I was 18. So I love seeing people that are 15, 16, 17, 18, 19 in that group, because you can go earn money. You don't have to go to college. You don't have to do what your traditional peers, family, friends are saying. You could do this kind of stuff, and that's totally viable. All right, that's all the questions I see on Instagram. So I'm gonna go ahead and turn these guys off for the night. Let's see what we have on Facebook tonight. Okay, let's see what we have here. Jason Connor. Jason's in insurance, so for Jason to say excellent explanation, that means we must be doing something right over here. Justin, is there a time when a surrender is a good idea? Excellent question. So Justin, there's never a time when a surrender is a good idea. However, there is a time where I could sell my policy to an investor, right? So let me share my screen again. And it's unfortunate Instagram is going to miss this, but Justin brings up a good question. Okay, so let's say that I'm down here in year 10, right? I'm in year 10 of my policy and I've got $1.3 million, okay? Or even better, let's go down here. Let's go even further towards the end of my life. Okay, so let's say I am 80 years old and I've got $21 million in my account, right? So I could surrender this, or I could borrow against it. Or I would never surrender it. I would always borrow because my dividend out earns the cost to borrow against it. But I could also sell this to investors. I could say, guys, if I go to the insurance company, they're only going to give me $21 million. Okay. I'm going to have, at the end of my life, I'm going to have $118 million. When I die, if I live till 120 years old, I'm going to have 118 million. Okay. So I'm going to sell you my policy, which we just said at age 80, I've got 21 million. I'm going to sell it to you guys for 60 million bucks. You're going to pay me 3 times what I have in cash value. You're going to pay me 60 million bucks. I'm going to make you the beneficiary. Okay, you're going to pay on it now. It's your policy. I'm done with it. You pay the 59 grand a year. You're going to finish paying on it. And when I die, you get whatever's in my death benefit. Okay, this is called a life settlement investment. Warren Buffett is one of the biggest investors in this category. So an insured will sell their policy, get cashed out for a multiple of what they have in their death benefit, and then they assign the beneficiary to the buyer. The buyer now picks up the premium, they cover the bill. When the insured dies, the buyer gets the death benefit. So I wanted to show you that because, guys, this is so versatile. You can save into it, you can surrender, you can borrow against it, you can sell it. Like, nobody talks about this stuff. So super good question. And the rate of return on those, if you want to be an investor in those, the rate of return on that type of deal is typically 12 to 15% a year. So that's called a life settlement investment. Josue, so saying technically we don't have to pay the loan back to the insurance company. Josue, that's totally right. So you never have to pay the loan back because you have the death benefit. So if you didn't pay it back, they're just going to subtract it out of your death benefit anyways. And that would be that. You'd be done and they'd be fine when you passed away. Jen, good to see you here. Josue says, Sacred Account Lite is specifically dedicated to debt. It's the best option to assist with paying off debt. Precisely. Lose on 401k in a bank. Brad, totally. That's 100% true. Josue, what's the best way to study insurance policies to better understand them? Any articles or book you'd recommend specifically? Josue, you have most of those. So our intermediate reading list, the case for IBC, bank on yourself, how privatized banking really works. That's all of the data there. And then we're going to continue releasing more courseware. There's a lot of it in Wealth Dynamics U already. So if you go in there, you read those books, you pretty much will get it. And if you go through that stuff, by the way, and you're like, I didn't get it, that means there's words you didn't get. So there's terminology there that went over your head. Go back through it with a fine-tooth comb and basically pick through it. I just blew Dan's mind. That's always fun. Justin says, what is the percentage of people that surrender their policy versus those who get the death benefit? So on whole life insurance policies, Justin, most people don't surrender them because after about 20 years, they're what's referred as paid up, meaning that you don't have to pay a premium and the death benefit will still pay out. So most people will get the death benefit. The crazy stat here, though, because like there's a lot of insurance agents that don't know about this, or they sell the wrong shit for the wrong company and design it wrong. Only about 6% of policyholders actually borrow against their cash value because it's not sold that way. It's sold as put money into this, and when you retire at 60, you might have a nest egg. So only about 6% of policyholders actually even borrow against their policy because they don't know they can, because their agent doesn't know they can, because he sold it to them the wrong way to get a higher commission. That pisses me off, but that's an amazing fact, versus what we're doing here. All of our clients borrow against our policies. There's actually some companies that if the agent takes a loan against the policy, they dock the agent's commission because they don't want people borrowing. They want to keep the money. So we don't work with that company. It's actually one of the bigger companies out there. Like if they're penalizing us for loans, that means we're not on the same page. The entire point of this is to take loans against it. All right, let me see what we have on Zoom here tonight. If there's any questions here. Keith, never too many spreadsheets. Send copies, please. Yeah, I can totally send those over, Keith. Keith and I have had some very good spreadsheet-based conversations via email. All right, I think that's all of the questions that we have tonight. So guys, I hope that gives you the fundamentals behind like the motor of the Sacred Account, how it works, why it's designed that way. Why does the insurance company give you cash value? Why do they let you borrow against it? All of that's answered here tonight. And I hope you can see like the mindset behind, if you're paying off debt, why this is a better place than the bank. If you're using the 401k or the bank for your savings right now, why this is a better place for that. If you are accredited and you have deals coming in from passive income, why this is a better place for that money to go as well. So that's the entire point of tonight. We're going to come out with some more stuff next week. If you were watching tonight and you had more questions, shoot me a message or an email. You can email me at jerry@wealthdynamics.com. You can also go to membership.jerryfetta.com. You can get a 2-week free trial of the Wealth Dynamics University. You get tons of content like this, and we will see you guys back again next Friday night. We do these every week. We always will. Oh, we do have one more question. Dominic says, how do we get a 2% loan when using it to put down a debt when most loan rates are 5% on policies? That's a good question. So Dominic heard me say you can borrow against your policy at 2 to 3%. So Dominic, that's your gross interest rate, meaning if I borrow and never pay the loan back. We don't do that. So if I'm borrowing, I'm either paying off debt or I'm investing. So if I'm paying off debt, the money that I used to make towards my debt, my minimum payments, I'm going to pay that back towards my life insurance loan now. When I do that, I'm reducing my principal. There's a term called net effective interest rate, meaning if I paid on my principal, my actual interest dollars only cost me about 2 to 3% because I'm reducing the principal value of my loan. Same thing if I do a real estate deal. When I get the cash flow, I'm going to save that somewhere. So I'm actually going to put that towards policy loan repayments, and then that's going to reduce down as well. So again, it's about 2 to 3%. Now, when you get a higher cash value, if you get at least 65 grand in cash value, I can actually broker you a private bank loan. So it's not an insurance company loan, it's a bank loan. It's got about a 3 to 4% gross interest rate instead of a 5 or a 6. With that, if we do the same concept, I'm actually going to pay a 1 to 2% net effective interest rate because I'm paying down my principal and my gross rate's already lower. So good catch, Dominic. A lot of people, guys, they tout this arbitrage thing on these accounts and like, yeah, you can borrow and the dividend's 6 and you can earn 5 and yada, yada, yada. The dividend can go down. The interest rate can go up. So you don't ever want to just take a loan and not pay it back. It's like owning a store and being like, yeah, it's my store. I can steal free apples. Technically, you're right, but also that's called embezzlement and it's going to affect your profit. So don't take the loan and not pay it back. Just like don't, own a gas station and take free gas, own a store and take free apples, have a mortgage company and borrow free money. Like all of those are bad business ideas, just like the idea of taking a life insurance loan and never paying it back. Yeah, you can get away with it. There's no obligation to pay back, but it's financially a bad decision and it's not profitable to do. So I hope that answers your question, Dominic. I think that that's everything. So guys, we're going to go ahead and tune out for tonight. Thank you for tuning in. Make sure that you like, share, and subscribe. And we will talk to you all next week.